Good morning, everybody. It's Bill Provost with Franklin Loan Center. Another Wednesday morning. Hey, this week I wanted to talk about what does move interest rates. I know last week with the Fed meeting and everything like that, I kind of, every time that meeting comes up, whatever it is, 8 or 9 times a year, I was kind of talking about how, hey, that isn't a direct impact on mortgage rates. So it does maybe raise the question, well, what does impact the mortgage rates, right? And so it gets a little complicated, but ultimately mortgage rates are driven by whatever's happening in the Fannie Mae or and there's different bonds and stuff like that, but generally the mortgage-backed securities is what drives those, right? So it's movement in the financial markets, in those the mortgage-backed securities. So that's ultimately what drives it. But the question is like, well, what moves those? Why do people get more or less interested in those, right? And so the quick answer is that look, I mean, there's two big buckets in the financial markets. There's fixed income or bonds, and then there's the equities markets, which kind of those two things generally move in opposite directions, right? So if people are feeling great about the economy, they're feeling better about getting into the equities markets and dumping their money in there, and they're feeling less interested in a long-term fixed bond. And so they move their money from bonds over to equities, right? And so that's a little bit what we've been seeing. The other thing that's really important is inflation is a really big, it's like the arch enemy of interest rates. So when inflation risk is there, it's always something that we've got to worry about. So that's what lately we've seen equity markets running like crazy. That's changed a bit over the last week or so, but so that's why we've seen bonds kind of come down to some degree. I mean, there's not an absolute correlation there, but it's certainly one that's proven year over year over year. So anyway, and so ultimately it's about just how people are feeling, how people, meaning large investors, are feeling about the economy and things that are happening, right? So that's why on a daily basis I'm watching out for things like like this morning was the third read or the third adjustment on GDP. GDP is a big one. It's got inflation factors in there. The market kind of shrugged it off this morning. And then there's all sorts of, so anything inflation related, I pay very close attention to, things like that. So what does this ultimately mean for my clients and my realtor partners and things like that is that, hey, look, I mean, you're going to buy a house whenever you're going to buy a house, and I'm going to lock in a rate accordingly, right? And so what I'm always looking to do is, are we going to lock in today or maybe tomorrow? But it's always risky to just let it run because we never know ultimately where things are going. But just have a general sense that that's what's going on. We have obviously zero control over which way they go, but we do have control over whether or not we lock you in, and we're always helping our clients with that. So if you need any help with that, give me a jingle. Love to chat with you more. Also, like, share, all that good stuff down below, and I will see you all next week.